Welcome to Iron Financial. Our mission here is simple: to help you forge a stronger portfolio. We don't chase trends, we don't listen to market noise. What we do is analyze the structural integrity of a company, piece by piece, to see if it's truly built to last. We're here to cut through the weakness and find the solid steel girders that support real, durable value. Today, a pharmaceutical titan is in our crosshairs, AstraZeneca. Let's get to work.
All right, let's get right into it. AstraZeneca just released their full year 2025 results, and believe me, they are talking a big game for 2026. They're not just hinting at growth, they have laid out an entire blueprint that promises investors some seriously powerful returns. The market seems to be eating it up, the stock's reacting well, analysts are upgrading. But you know what? That's exactly why we're here. The time to be most vigilant is when everyone else is optimistic. So the question is this pharma giant really built on solid steel, or are we just looking at a pretty facade with some major cracks in the foundation? I'm seeing a lot of confidence, but I need to know if the financial structure can actually bear the load of these promises. You know, is it all hype, or is it real?
And that is absolutely the right question to be asking. A forecast is just that, a plan. It's not a promise that's been cast in iron. So let's start with that very plan, the official guidance that AstraZeneca published with their Q4 2025 results. Let's begin at the top line. For 2026, AstraZeneca is forecasting mid to high single-digit % growth in total revenue. Now let that sink in for a second. We're talking about a company that's already pulling in close to $60 billion a year. This forecast means they expect to find an additional $4 to $5 billion in sales. In this volatile market, with all the geopolitical and macroeconomic uncertainty that they themselves admit to in their filings, well, that's a seriously confident statement of intent. They are signaling to the market that they have the machinery to keep this entire massive enterprise growing at a very, very healthy pace. And this blueprint, it gets even more ambitious. Because it's not just about how much you sell, it's about what actually drops to the bottom line, what really benefits the owners of the company. The second piece of their guidance is that Core EPS, earnings per share, is expected to increase by a low double-digit %. Now look, for a company of this scale, that is not just growth, that is some serious heavy lifting. They're making a promise to not only sell more product, but to do it more profitably, delivering strong returns directly to their investors in a market that is absolutely starved for real yield. So this is the blueprint they've handed to Wall Street. On paper, it's a solid structure, promising both massive scale and impressive efficiency.
Whoa, hold on a minute. Blueprints are just paper. I've seen countless ambitious architectural plans that never became anything more than a vacant lot. Forecasts, guidance, all of it is just forward-looking talk. It's the company's PR department telling you what they hope will happen, and it's all packaged up nicely for an investor call. We're Iron Financial. We don't invest in hope, we invest in solid structures. So enough with the blueprints. It's time to put on the hard hats and really drill down. Let's go inspect the actual foundation, the hard numbers, the profit and loss statement, the balance sheet. Can the company's current financial structure actually support this kind of massive expansion, or is it going to buckle under the weight of its own ambition?
Couldn't agree more. Let's get into the steel and the concrete of the financials. A strong forecast needs a rock-solid foundation, so we're going to start exactly where we should, the profit and loss statement for the full year 2025. This document, right here, is the ultimate judge of performance. It's where we can see the raw power of the company's earnings engine. We're going to examine the revenue, we're going to look at the costs, and we're going to check the ultimate profitability to see if that engine is really firing on all cylinders. This is the ground truth. No more talk.
Whoa, not so fast. Before you flash a single number up there, we need to talk about this, because this is critical. If you look at their own financial documents, they're talking about two different sets of books, reported and core. So what exactly are we looking at here? Reported financials are the standard, GAAP-audited numbers, the ones the SEC actually requires. But core financials, as AstraZeneca defines them, are adjusted. They conveniently strip out things like restructuring costs, amortization of intangibles from big acquisitions, legal settlements. You get the picture, all the inconvenient expenses. They claim it's to show underlying performance, but I have to ask, is core the real story, or is it just a polished, airbrushed version of the truth? Which number is actually carrying the weight here?
That is a fair challenge, and you're right, transparency is absolutely critical. So let's start with the unvarnished truth, the reported P&L statement. No adjustments, no core metrics, just the straight audited numbers. And the sheer scale of this operation is, well, it's immense. Just look at that top line. Total revenue for the full year 2025 clocked in at $58.739 billion. That's a massive, massive number.
But more importantly, it represents an 8% increase at constant exchange rates. This company isn't just big, it's growing at a really formidable pace, adding billions and billions in new revenue year over year. That top-line momentum is the very first pillar of any growth story, and from where I'm sitting, it looks solid as a rock. Okay, an 8% revenue bump is respectable. I'll give you that. But my eyes are immediately drawn to what's below that line on the full P&L. The operating expenses they're staggering. We're talking $14.2 billion just on R&D and another $19.9 billion on SG&A. That's selling, general, and admin costs. That adds up to over $34 billion in spending just to keep the lights on and the labs running. That is more than the entire revenue of many, many Fortune 500 companies. You can have all the revenue in the world, but if your costs are that high, it feels like you're just running on a treadmill. That's a massive burn rate. And that's exactly the point. The spending is immense, but you have to look at the leverage it's creating. As this table shows, that spending is incredibly productive. Yes, the costs are huge, but the profit growth is even bigger. Operating profits surged by 36%. That is not a typo. That means for every new dollar of revenue they bring in, a much larger chunk is falling right to the bottom line. And reported earnings per share, the number that actually matters to shareholders, skyrocketed by 43%. So the crucial point here is, yes, they are spending a lot of money, but that spending isn't just a cost, it's fuel. It's not just turning the lights on, it's building a skyscraper of profit.
So, the high-level financial framework, it appears to be robust. Strong revenue growth is translating into even stronger profit growth. That financial leverage is clearly working. But a building is only as strong as it supports. So now we need to look inside the machine. What are the specific engines that are driving this growth? Which products are the actual load-bearing pillars supporting this entire multi-billion-dollar structure? Let's break down that nearly $59 billion in revenue and see where the real strength is coming from.
You know, when we break down their revenue, one division stands out as the main engine. Now, AstraZeneca is a diversified company, no doubt about it. They have major divisions in CVRM, that's cardio, renal, and metabolism, pulling in a massive $12.9 billion. Their respiratory and immunology division, or R&I, is another giant at $8.9 billion. I mean, those are huge businesses in their own right, each one larger than many entire pharmaceutical companies. But the main engine, the absolute powerhouse that's driving this growth, is oncology. As you can clearly see, it's the largest slice of the pie, and it's not just big, it's growing fast, up 14% in 2025. This is the core of the growth engine we were just looking at in the P&L.
And you know, we can drill down even further than that. Within that massive oncology franchise, the weight is not distributed evenly. This is the power of a true blockbuster drug in action. Two products stand out as the twin pillars holding up the entire division. First, you've got Tagrisso, a lung cancer therapy, pulling in over $7.2 billion in sales just for 2025 alone. Right behind it is Imfinzi, an immunotherapy, with over $6 billion. Together, that's more than $13 billion from just two drugs. These aren't just successful products. These things are financial fortresses. They have strong market positions and years of patent life ahead of them, and they're generating these incredible revenue streams that fund the entire enterprise.
Okay, I see two pillars, and that makes me nervous. That sounds a lot like concentration risk. I mean, what happens if something goes wrong with the market for Tagrisso or Imfinzi? A new competitor, a pricing issue, a bad clinical trial result for a new indication? Doesn't that put the whole structure at risk? It sounds like a building that's just resting on two columns. One good shake, and the whole thing could become dangerously unstable. And that's a valid concern. Any solid structure needs more than two supports. But while oncology is the main engine, it is not the only one. Just look at the CVRM division. The drug Pharmaceutical is a multi-billion-dollar product providing critical support, and it has strong growth in treating heart failure and kidney disease, expanding way beyond its original diabetes indication. And over in R&I, Fasenra, a treatment for severe asthma, is doing the exact same thing. These aren't small niche drugs. These are major blockbusters that provide essential diversification. It shows the company is engineered with multiple points of strength, not just a single point of failure.
All right, so the current structure looks solid. The financials are strong, and the revenue is being powered by several blockbuster products across a few different therapeutic areas. But in the pharmaceutical world, you can't stand still. A drug portfolio is like a building that's in a constant state of renovation. You always have to be building the next floor because patents expire and the competition is absolutely relentless. So let's shift our focus from current performance to future growth. We need to inspect the blueprint for expansion, the R&D pipeline. This is where the blockbusters of tomorrow are forged. And the scale of AstraZeneca's ambitions here is it's immense. I want you to just look at this number taken directly from their clinical trials appendix. 197. That's not a typo. They have 197 different projects currently in the development pipeline. This isn't just a plan for a new floor. This is a blueprint for an entirely new city of products. It's a massive, massive investment in the future, designed to create waves of new drugs across all their key therapy areas for years and years to come. The sheer scale of it is meant to overwhelm the competition and ensure long-term durability. It is a statement of force.
And listen, it's not just about quantity, it's about the quality and the potential impact. Let's look at some of the most promising assets in their late-stage pipeline. You've got datoramycin, an antibody-drug conjugate, which is this highly advanced technology that acts like a guided missile for cancer cells. The market for that class of drug is exploding right now. Then there's camizestrant, a next-gen oral therapy for breast cancer, entering a multi-billion-dollar market that's currently dominated by older drugs. In respiratory, you have tozorakimab for COPD, which targets a huge unmet need. And in oncology again, volrustomig combines two proven immunotherapy approaches into a single molecule. Finally, wenectodonia for a rare heart condition, which, despite being rare, has a very high-value market. This isn't just a random collection of bets. It is a strategically diversified portfolio of high-potential assets that are aimed at creating multiple new pillars of revenue.
Stop right there. This is exactly where the beautiful blueprint meets the brutal reality of construction. That big number, 197, it's impressive, but it's also incredibly misleading. I want to put up a direct quote. This isn't from a critic, this is from AstraZeneca's own aid memoir, a document they send to the sell-side analysts who actually model their stock. They explicitly ask analysts, please provide the probability of success, POS, if using a risk-adjusted approach. Get that? The company itself is telling the market in black and white not to take these pipeline projects at face value. They're openly admitting that each and every one carries a significant risk of failure.
Let me just drive this point home. A pipeline is just a list of possibilities. It's a big stack of lottery tickets, and most of them will not pay out. Drug development is a brutal, expensive, and failure-prone business. For every single success, there are dozens of failures that burn through hundreds of millions, sometimes billions of dollars. The inherent risk of clinical trials means that many, if not most, of those 197 projects will never see the light of day. They'll fail in phase 2 or phase 3 or get shot down by the regulators. They will never generate a single dollar of revenue. So a big blueprint does not guarantee a strong building. Execution is absolutely everything. That number 197 represents potential, not profit, and there is a massive difference between the two.
And that is the crucial point of tension in this entire analysis, and you are absolutely right to raise it. The pipeline risk is real, and the company themselves, they acknowledge it. The potential is immense, but the path to realizing that potential is littered with trapdoors. So we've seen the strength of the current financial foundation, and we've seen the ambition of the future blueprints. It's time to weigh the solid steel against the potential cracks. It's time to put it all together and deliver the final verdict.
So let's lay it all out on the table. The bull case is clear, and it's compelling. You have strong, 8% top-line revenue growth that is feeding an incredible 43% jump in reported EPS. That's real, tangible performance. This whole thing is powered by a dominant, growing oncology franchise that is frankly the envy of the entire industry. And when you look forward, they have a massive, diversified R&D pipeline with 197 shots on goal, all of it supporting a confident 2026 guidance for double-digit earnings growth. But the bear case is just as compelling. Those incredibly high operating costs are a constant pressure on the margins, and they require flawless execution just to maintain profitability. The company is heavily dependent on just a few key blockbuster drugs, and that creates the concentration risk we talked about. That massive pipeline is subject to an equally massive risk of clinical trial failures. And we haven't even touched on the external factors that the company itself warns about, like geopolitical and macroeconomic volatility, which can disrupt global supply chains and sales in an instant.
So, what is the iron verdict? After inspecting the foundation and looking over the blueprints, our assessment is this. AstraZeneca's current framework is solid, the financial structure is robust, and its growth engine, led by that oncology division, is firing powerfully. The blueprint for the future, that massive R&D pipeline, is incredibly ambitious and it holds enormous potential. However, potential is not performance. Transforming that blueprint into a revenue-generating reality is going to require flawless execution, and frankly, a significant amount of luck. The high risk of clinical failure is a non-trivial factor that you just can't ignore. So, our final analysis is that this is a structure that is built for strength, but it is not completely bulletproof. It is not immune to market tremors and the inherent risks of its industry. The foundation is strong, but the taller you build, the more vulnerable you are to the wind. That's the analysis. Now it's up to you to decide how it fits into your portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.